Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Understanding Internal Rate of Return, IRR, a guide for smarter investment decisions. Making smart investment choices means understanding how to measure potential returns. That's where the internal rate of return, IRR, comes in. IRR helps investors evaluate and compare projects, showing how well an investment might perform over time. It's a key tool for businesses deciding where to put their money, and one every investor should know about. Whether you're managing a portfolio or reviewing a project, IRR simplifies complex decisions and makes comparing options easier. Let's break it down. What is internal rate of return, IRR? Internal rate of return, IRR, is an essential concept in evaluating investments. It acts as a measuring stick for project profitability, helping decision-makers weigh the potential benefits of different opportunities. Whether you're assessing a new business project or determining the value of a personal investment, IRR provides clarity. Let's explore what it means and how it's calculated. Definition of IRR. IRR is the discount rate at which the net present value, NPV, of all cash flows from a project equals 0. In simpler terms, it's the rate of return an investment is expected to generate based on its future cash flows. When IRR matches your required return or exceeds it, the investment can be considered worthwhile. Think of it as the break-even interest rate. If you imagine cash flows as a series of inflows and outflows, IRR is the exact rate that balances those flows over time. When comparing multiple investments, IRR helps identify which option has the highest profitability potential. Mathematical representation. To understand IRR better, let's look at its formula. The calculation itself requires trial and error, or software, but here's the core formula. 0 equals NPV equals sigma, quart, 1 plus IRR, caret T, C0. Here's what each part means. Quart, cash inflow or outflow during time period T. C0. Initial investment or cost at time T equals 0. T. The specific time period, e.g., year 1, year 2. IRR. The internal rate of return we're solving for. The formula essentially compares the present value of future cash flows to the cost of the investment. IRR is the rate where this difference becomes 0. While the math may seem complicated, tools like Excel or financial software simplify this process. The key takeaway? IRR tells you how efficiently your money is working in an investment. It's like finding the sweet spot where everything balances, giving you a clearer picture of potential returns. The importance of IRR in investment decisions. When it comes to making informed investment decisions, IRR plays a central role. Investors and businesses rely on this metric to gauge the profitability of projects and compare different opportunities. It helps answer a key question: is this investment worth the risk and resources? Let's dig deeper into how IRR stands out compared to other metrics and how it shapes decision-making. Comparing IRR with other metrics. Choosing the right financial metric can be tricky, as each one tells a different story. IRR, net present value, NPV, and return on investment, ROI, are often used together, but they serve distinct purposes. Here's how IRR stacks up. IRR versus NPV. IRR focuses on the rate of return, while NPV measures the value created by an investment. NPV gives you an exact dollar figure, showing how much wealth you'll gain, assuming a specific discount rate. If you're prioritizing a precise monetary outcome, NPV is your go-to. However, IRR shines when comparing projects with varying costs and durations, as it normalizes returns into an annualized percentage. IRR versus ROI. ROI is straightforward. It shows the percentage return based on your initial investment. While it's simple and often effective, ROI doesn't account for time, which limits its accuracy for long-term projects. IRR, on the other hand, factors in the time value of money, giving a fuller picture of a project's profitability over its lifecycle. By combining these metrics, you get a well-rounded analysis. IRR helps prioritize opportunities with higher efficiency, while NPV and ROI fill in the gaps by offering context and alternative perspectives. Investment decision criteria. How do you know when an IRR is good? The answer depends on your unique goals and the project specifics. Here's a breakdown of how to use IRR as part of your decision-making process. Set a benchmark. The first step is to compare IRR against your desired rate of return or hurdle rate. This rate represents the minimum return required to justify the investment. For example, if your hurdle rate is 10% and the project's IRR is 15%, the investment looks promising. Understand risk versus reward. A higher IRR doesn't always mean the investment is better. Sometimes, projects with a high IRR come with greater risks or less stable cash flows. Always pair IRR with a solid risk assessment to avoid potential pitfalls. Compare alternatives. When picking between projects, IRR provides a straightforward comparison. If two projects have similar risks and lifespans, the one with the higher IRR often makes more sense. Keep in mind, though, that IRR works best when comparing projects of similar size. Account for timing. Remember, IRR is about returns over time. It's ideal for projects with consistent cash flows but might misrepresent situations where returns fluctuate significantly. Use it alongside other tools to confirm the timing of returns aligns with your financial goals. In short, a good IRR is one that exceeds your hurdle rate and aligns with your risk tolerance. But don't rely on IRR alone. It's a powerful tool, but its full value comes when combined with other metrics and a deep understanding of the investment's context. How to calculate IRR. Knowing how to calculate IRR can make or break your investment decisions. Whether you choose to crunch the numbers yourself or use tools, understanding the process is essential. Below, we break it down into 3 simple approaches. Manual calculation of IRR. Explain the trial and error method and provide an example. Calculating IRR manually can feel like solving a puzzle, but it isn't impossible. It involves finding the discount rate that sets the net present value, NPV, to 0. Since the IRR formula doesn't have a direct solution, we use trial and error. Here's the basic process. Plug an estimated IRR into the NPV formula. Calculate NPV using that rate. Adjust the IRR up or down depending on whether NPV is positive or negative. Repeat until the NPV equals 0, or close enough. Let's look at an example. Imagine a project costs $10,000 upfront and returns $4,000 annually for 3 years. To calculate IRR, start with a discount rate, say 10%. Formula. NPV equals 10,000 plus 4,000, 1 plus 0.10, caret 1 plus 4,000, 1 plus 0.10, squared plus 4,000, 1 plus 0.10, cubed. NPV equals 10,000 plus 3,636.36 plus 3,305.79 plus 3,005.26 equals $52.59. Since NPV is close to 0, the IRR is approximately 10%. If NPV had been positive, you'd try a higher discount rate, and vice versa. This approach can take time, but it's a great way to understand the relationship between cash flows and IRR. Using financial software and calculators. Discuss how software can simplify IRR calculations and provide examples. Why spend hours manually calculating IRR when financial tools can do it for you? Modern software and calculators make this process quick and error-free. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.